Section 4 Best Practices and Strategies. 4.1 Setting Realistic Stop-Loss Levels. Setting stop-loss levels based on market conditions, volatility, and individual risk tolerance is crucial for effective risk management. Here's why it is important. Market conditions. Market conditions play a significant role in determining the appropriate stop-loss levels. Different market environments exhibit varying levels of volatility, liquidity, and price movements. During periods of high volatility or increased uncertainty, wider stop-loss levels may be required to accommodate larger price swings and reduce the risk of premature stop-outs. Conversely, during low volatility periods, tighter stop-loss levels may be sufficient to manage risk. Adapting stop-loss levels to prevailing market conditions helps align risk management with the current dynamics of the market. Volatility assessment. Volatility is a key factor to consider when setting stop-loss levels. Higher volatility implies greater price fluctuations and the potential for larger losses. By assessing historical volatility or using volatility indicators, traders can gauge the appropriate range for stop-loss levels. A volatile market may require wider stop-loss levels to account for price swings, while a less volatile market may allow for tighter stop-loss levels. Adapting stop-loss levels to reflect volatility helps maintain risk consistency and protects against excessive losses during turbulent periods. Risk tolerance. Individual risk tolerance is a crucial factor in determining stop-loss levels. Each trader has their own comfort level with risk and the amount they are willing to tolerate on each trade. Stop-loss levels should be set in a way that aligns with the trader's risk tolerance and overall risk management strategy. Setting stop-loss levels beyond one's risk tolerance may lead to excessive losses and emotional distress, while setting them too conservatively may result in missed opportunities. It is important to find a balance that allows for risk management while still providing room for trades to develop. Trade analysis and targets. Stop-loss levels should be set based on the analysis of the trade setup and the desired profit target. Traders should consider key support and resistance levels, chart patterns, and technical indicators to determine where stop-loss levels should be placed to protect against potential invalidation of the trade idea. Additionally, the potential profit target should be assessed to ensure that the risk-reward ratio is favorable. Stop-loss levels should be set at a distance that allows for potential profits to outweigh potential losses, taking into account the trader's desired risk-reward ratio. By considering market conditions, volatility, individual risk tolerance, and trade analysis, traders can set stop-loss levels that are appropriate for each trade. Adapting stop-loss levels based on these factors helps ensure that risk is effectively managed. Potential losses are contained, and trades have a higher probability of success. It is important for traders to regularly review and adjust stop-loss levels as market conditions change to maintain consistency in risk management and align with evolving market dynamics. Determining appropriate stop-loss levels for different trading scenarios requires a combination of technical analysis, risk management principles, and understanding of market dynamics. Here are some techniques that traders can employ. Support and resistance levels. Support and resistance levels are key areas on a price chart where buying or selling pressure has historically caused the price to reverse or stall. Traders can set stop-loss levels below support levels when buying and above resistance levels when selling. This technique helps protect against potential breakdowns or breakouts that could invalidate the trade. Volatility-based stops. Volatility-based stops adjust the stop-loss level based on the volatility of the market or the specific instrument being traded. Volatility indicators such as average true range, ATR, can help determine the appropriate distance for stop-loss levels. A wider stop-loss level may be used in highly volatile markets to account for larger price swings, while a tighter stop-loss level may be sufficient in low volatility conditions. Moving averages. Moving averages can serve as dynamic support or resistance levels. Traders can set stop-loss levels below a rising moving average when buying and above a declining moving average when selling. This technique helps traders stay in a trade as long as the moving average supports the prevailing trend but provides an exit if the price moves against the trend. Chart patterns. Chart patterns, such as triangles, flags, or head and shoulders, can provide insights into potential price movements. Traders can set stop-loss levels outside the pattern's boundaries to protect against false breakouts or breakdowns. For example, if a trader identifies a bullish triangle pattern, the stop-loss level could be placed below the lower trend line of the triangle. Percentage-based stops, traders can use a percentage of the entry price to determine stop-loss levels. For example, a trader might decide to set a stop-loss level at 2% below the entry price. This approach ensures that the risk on each trade is consistent and allows for adjustments based on the trader's risk tolerance. Indicator-based stops, technical indicators, such as the Relative Strength Index, RSI, or Bollinger Bands, can be used to set stop-loss levels. For example, a trader might place a stop-loss level below the recent swing low indicated by the RSI or below the lower Bollinger Band to protect against potential trend reversals or overextended price moves. It's important to note that these techniques are not standalone strategies but rather tools to assist in determining appropriate stop-loss levels. Traders should consider multiple factors, including market conditions, volatility, timeframe, and individual risk tolerance, when setting stop-loss levels. Additionally, regular monitoring and adjustment of stop-loss levels as the trade progresses and market conditions change are crucial to effective risk management. 4.2 Trailing stop-loss orders. Trailing stop-loss orders are a type of stop-loss order that automatically adjusts as the price moves in favor of the trader. Unlike a traditional stop-loss order, which remains fixed at a predetermined level, a trailing stop-loss order allows traders to lock in profits and limit downside risk as the trade progresses. Here's how trailing stop-loss orders work and their benefits. Dynamic risk management. Trailing stop-loss orders provide dynamic risk management by adjusting the stop-loss level based on price movements. As the price moves in the trader's favor, the trailing stop-loss order trails behind the current price at a specified distance. This allows traders to capture potential profits while ensuring that they are protected if the price reverses, locking in profits. One of the key benefits of trailing stop-loss orders is the ability to lock in profits as the trade progresses. As the price moves in favor of the trader, the trailing stop-loss order adjusts higher, for long positions, or lower, for short positions, protecting the gains achieved. If the price subsequently reverses and reaches the trailing stop-loss level, the trade is exited, and the profits captured up to that point are secured. Allowing for potential upside, trailing stop-loss orders provide traders with the flexibility to participate in potential extended price moves. As the stop-loss level adjusts higher with the rising price, for long positions, it allows the trade to potentially capture more significant gains if the trend continues. This feature is particularly beneficial in trending markets where prices can make sustained moves in one direction, limiting downside risk. While trailing stop-loss orders allow for potential upside, they also help limit downside risk. By adjusting the stop-loss level higher as the price rises, the trader is protected against significant reversals. If the price turns against the trade and reaches the trailing stop-loss level, the trade is automatically exited, limiting potential losses. This feature helps protect profits already gained and helps traders manage risk more effectively, reducing the need for constant monitoring. Trailing stop-loss orders eliminate the need for constant manual adjustment of stop-loss levels. Traders can set a trailing stop distance based on their risk tolerance and trading strategy and allow the order to automatically trail the price. This frees up time and reduces the emotional stress associated with constantly monitoring and adjusting stop-loss levels. It's important to note that trailing stop-loss orders are not without limitations. They may result in premature exits during volatile market conditions or in cases where prices experience sudden reversals. Traders should consider the specific characteristics of the market, volatility, and their trading strategy when utilizing trailing stop-loss orders. Regular monitoring and adjustment of the trailing stop distance as the trade progresses can help optimize its effectiveness. Setting trailing stop-loss levels effectively involves considering various factors, including market conditions, volatility, trade objectives, and risk tolerance. Here are some strategies for setting trailing stop-loss levels. Percentage-based trailing stops. One approach is to set the trailing stop distance as a percentage of the price's peak or trough. For example, a trader might use a trailing stop of 5% below the highest price reached since entering a long position. This approach allows for flexibility while still protecting profits. However, it's important to consider the volatility of the instrument and adjust the percentage accordingly. Volatility-based trailing stops. Volatility-based trailing stops consider the instrument's inherent price volatility. By using a volatility indicator, such as average true range, ATR, traders can determine the appropriate distance for the trailing stop. A wider trailing stop may be used in highly volatile markets to account for larger price swings, while a tighter trailing stop may be sufficient in low volatility conditions. Moving averages as trailing stops. Traders can utilize moving averages as trailing stops, particularly when employing trend-following strategies. The trailing stop level can be set slightly below a rising moving average for long positions or above a declining moving average for short positions. As long as the price remains above the moving average, the trade is maintained. If the price closes below the moving average, the trade is exited. Support and resistance as trailing stops. Traders can use support and resistance levels as trailing stops. When in a long position, the trailing stop can be set just below key support levels, allowing for some price fluctuations while still protecting against significant reversals. In a short position, the trailing stop can be set just above critical resistance levels. Trailing stops based on chart patterns. Traders can set trailing stop-loss levels based on specific chart patterns, such as trend lines, channels, or chart formations. For example, a trader may use a trend line as a trailing stop for a trend-following trade. As the price moves in favor of the trend, the trailing stop follows the trend line, protecting against a potential trend reversal. Time-based trailing stops. Traders can set trailing stops based on specific time intervals. For example, they may decide to exit a trade if it hasn't reached a specified profit target within a certain time frame. This approach can help capture profits within a defined period and protect against prolonged sideways movements or changes in market conditions. It's important to adapt trailing stop-loss strategies based on the trader's risk tolerance, trade objectives, and the specific characteristics of the instrument being traded. Regular monitoring of the trade's progress and periodic adjustment of the trailing stop distance can help optimize its effectiveness. Traders should also consider employing a trailing stop strategy in conjunction with other risk management techniques, such as position sizing and profit targets, to create a comprehensive risk management plan. 4.3 Monitoring and adjusting stop-loss orders. Regular monitoring and adjustment of stop-loss orders are essential for effective risk management and adapting to changing market conditions. Here's why it is important: adapting to market volatility. Markets are dynamic, and volatility levels can fluctuate over time. By regularly monitoring the market and adjusting stop-loss orders, traders can ensure that their risk levels are appropriate for the current market conditions. During periods of high volatility, wider stop-loss levels may be necessary to accommodate larger price swings and avoid premature stop-outs. Conversely, during low volatility periods, tighter stop-loss levels may be sufficient. Regular monitoring allows traders to stay in tune with market dynamics and make necessary adjustments, protecting profits and reducing losses. As a trade progresses, the risk-reward profile may change. By monitoring the trade and adjusting the stop-loss level, traders can protect profits already gained and reduce potential losses. If the trade has moved significantly in their favor, traders can consider trailing the stop-loss order to lock in profits and secure a larger portion of the gains. On the other hand, if the trade is showing signs of weakness or the market conditions have shifted, adjusting the stop-loss level can help limit losses and preserve capital, reflecting changes in trade setup or market sentiment. The initial reasons for entering a trade may change over time. Market conditions, news events, or technical factors can alter the trade setup or sentiment. Regular monitoring allows traders to reassess their trade thesis and adjust the stop-loss level accordingly. If new information suggests that the original trade idea is no longer valid, it may be necessary to tighten the stop-loss level or exit the trade altogether. Monitoring the trade provides an opportunity to adapt to evolving market dynamics and make informed decisions, avoiding complacency and emotional biases. Regularly monitoring trades helps traders stay engaged and avoid complacency. It prevents the tendency to set and forget stop-loss orders without considering new information or developments in the market. Emotional biases, such as attachment to a trade or fear of missing out, can cloud judgment and lead to poor risk management. By actively monitoring and adjusting stop-loss orders, traders can mitigate these biases and make objective decisions based on the most current market information. Incorporating trade management and adjustments. Stop-loss orders are not static, they should be viewed as part of an overall trade management plan. Monitoring and adjusting stop-loss levels allow traders to incorporate other trade management techniques, such as scaling out of a position, adding to a winning trade, or adjusting profit targets. It enables traders to respond to changing market conditions and optimize their risk-reward profiles. In summary, regular monitoring and adjustment of stop-loss orders are crucial for adapting to market conditions, protecting profits, reducing losses, and maintaining a disciplined approach to risk management. By staying actively involved in trade management and being responsive to changing market dynamics, traders can enhance their overall trading performance. Modifying or tightening stop-loss levels in response to market conditions is an important aspect of trade management and risk control. Here are some considerations for when and how to adjust stop-loss levels. Price volatility. If the market becomes more volatile, it may be prudent to tighten stop-loss levels to reduce the risk of being stopped out by short-term price fluctuations. This can help protect profits and prevent premature exits. Conversely, if volatility decreases, widening the stop-loss level may be appropriate to allow for a more significant price range and avoid unnecessary stop-outs. Support and resistance levels. If the price approaches a key support or resistance level, adjusting the stop-loss level in relation to these levels can be beneficial. For example, tightening the stop-loss level below a support level can protect against potential breakdowns, while adjusting it above a resistance level can guard against false breakouts. This approach considers critical price levels and helps manage risk in relation to the market structure. Moving averages or trend lines. Traders often use moving averages or trend lines to identify the prevailing trend. Adjusting the stop-loss level in line with these indicators can help protect profits and stay in the trade as long as the trend remains intact. If the price closes below a rising moving average or breaks a trend line, it may signal a potential trend reversal, warranting an adjustment to the stop-loss level. Trade objectives. Reassessing trade objectives can prompt adjustments to stop-loss levels. If the trade has achieved a substantial portion of the intended profit target, it may be appropriate to tighten the stop-loss level to secure profits and reduce the risk of a reversal. Similarly, if new information or analysis suggests that the trade setup is no longer valid, it may be necessary to adjust the stop-loss level or exit the trade. Trailing stop-loss orders. Trailing stop-loss orders automatically adjust as the price moves in favor of the trade. This trailing mechanism allows traders to lock in profits and protect against reversals. Traders can choose to trail the stop-loss level by a fixed distance or use dynamic indicators like moving averages or volatility-based measures. Trailing stops are particularly useful in capturing profits during trending markets while maintaining a protective exit strategy. Time-based adjustments. Depending on the trading strategy and timeframe, periodic adjustments to stop-loss levels can be made. For example, at the end of each trading day or week, traders may review their positions and adjust stop-loss levels based on the market's behavior and new information. This approach ensures that stop-loss levels remain relevant and aligned with the latest market conditions. It's important to remember that adjustments to stop-loss levels should be made based on a thorough analysis of market conditions, risk tolerance, and individual trading objectives. Regular monitoring of the trade's progress, staying informed about market developments, and employing sound risk management principles are essential for making effective adjustments to stop-loss levels.